Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down Salesforce, Inc., ticker CRM. Now, this is a name most people in business know, a real giant in enterprise software. They basically invented software as a service, or at least perfected it for the enterprise, and they're still shaping how businesses connect with customers. But the real question for us as long-term investors is this. Beyond the hype and the huge market cap, what's the real quality here? Are there hidden strengths or maybe hidden cracks that the market isn't fully appreciating? That's what we're here to find out.
That's a massive question. And, understanding these companies that are so deeply woven into the digital economy is, well, it's crucial. Our goal today is really to cut through all the noise, the day-to-day chatter, and get to the core investment thesis for Salesforce. We'll look at the strengths, sure, but also the potential vulnerabilities. And as we go through this, really think about what stands out to you. How does a company like Salesforce, especially as it keeps evolving with AI and everything else, fit into your view of technology and business?
That's a massive question. And before we get into the details, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comment section.
Perfect. Now let's get into it. Pillar number 1, the business model. Okay, let's unpack this business. Salesforce famously pioneered a whole new way of delivering software. We hear SaaS all the time, but how does Salesforce actually make money, and what was so special about their model?
Well, at its heart, it's software as a service, SaaS. They were definitely pioneers, maybe the pioneers in perfecting it for big enterprise needs. The beauty of it really is the recurring revenue. Customers pay subscription fees, monthly or annually, often per user, and they access everything through the cloud. No big upfront software purchase, no managing servers internally, at least not for the core application.
Right, that predictable recurring revenue. That's the dream for a lot of businesses, isn't it? Not just one-off sales.
Exactly, and that's the vast majority of their income. We're talking 94% comes from subscription and support. In fiscal 24, that was something like $32.5 billion out of almost $35 billion total. It's a huge, predictable engine, high-quality revenue. The other, say, 6-7% is professional services. Think consulting, implementation, training.
Okay, so that sounds smaller, but strategically important.
Oh, absolutely vital. This is how they get customers properly set up, integrated, customized. It makes sure the software actually works for their specific business. And crucially, it embeds Salesforce much deeper into the customer's operations, makes it much harder, much costlier to even think about switching later on.
So it's not just selling software, it's becoming part of the customer's operational DNA, almost like their central nervous system for customer stuff. That sounds sticky.
Precisely. And the core value proposition is timeless, right? Helping businesses find, win, and keep customers. That's not going away. It's a fundamental need, not some tech trend. Plus, you've got these huge tailwinds.
Like digital transformation. Everyone trying to get their customer data sorted out.
Exactly. Every company needs a central place to manage customer interactions. And now, with AI exploding, well, you can't do AI effectively without good, unified data. That's where Salesforce's Data Cloud comes in. It's their big push to unify all that scattered customer data into one place.
Okay, here's where it gets really interesting, I think. AI isn't just a buzzword for them. It feels like a genuine tailwind. Data Cloud, and you mentioned Agentforce AI. What's that?
Right. Agentforce AI is their suite of AI tools. Think generative AI, predictive AI, all built specifically for customer interaction, sales, service, marketing, the whole lot. It uses the data in Data Cloud to automate tasks, give smarter insights, help service agents respond better, personalize marketing, you name it. This lets them do that land and expand thing even better.
Ah, the classic land and expand. Start small, grow bigger within the account.
Yeah, a company might start with just Sales Cloud, but then they see how well it works, how it integrates, so they add Service Cloud, then Marketing Cloud, then maybe Commerce Cloud. Suddenly, Salesforce isn't just a tool for the sales team. It's the central operating system for everything customer-related across departments. And pulling that out, way, way harder than replacing one single piece of software.
If you think about your own experiences as a customer, how often do you wish companies had a single view of you? You call, you email, you chat, and you have to repeat everything. That's the exact problem Salesforce is trying to solve for businesses. Makes them pretty indispensable when they get it right. Okay, so solid model, very sticky. But what about defenses? How do they protect this position from competitors? We're talking huge tech companies here.
Yeah, they have what investment folks like Warren Buffett or Morningstar would call a wide economic moat, a really durable competitive advantage. And it's mainly built on really, really high switching costs, plus some other things like network effects and brand.
High switching costs. Okay, that makes sense. But break that down. Where do those costs actually hit a business if they tried to leave Salesforce?
Well, there are three big interlocking pieces. First, deep operational integration. Like we said, it becomes the nervous system. It's embedded in daily workflows, sales processes, service scripts, marketing campaigns. Pulling it out is like major surgery on the organization. Huge disruption.
Okay, so operational chaos. What else?
Second, data entrapment. Or maybe data gravity. Companies build up years, sometimes decades, of customer data, interaction history, custom reports, all inside Salesforce. Moving that data, petabytes of it, off into another system. It's technically nightmarish, incredibly risky, and super expensive. You risk losing data, breaking compliance rules. It's daunting.
And the third piece?
Human capital. Companies spend a ton training their people, thousands of employees sometimes, on how to use Salesforce effectively. If you switch, you have to retrain everyone. That means massive costs, huge productivity dips while people learn the new system, and probably a lot of resistance from users who knew the old system.
So it's the operations, the data, and the people.
Yes.
All locks you in. What about those secondary defenses you mentioned? Network effects.
Right, that comes mainly from the AppExchange. It's their marketplace, launched way back in 2005. It has over 5,000 apps from other companies that plug into Salesforce, extending what it can do. This creates a powerful network effect. More customers using Salesforce attracts more developers to build apps for the AppExchange. More useful apps make Salesforce even more valuable to customers. It's a virtuous cycle.
A flywheel effect, basically.
Exactly. It creates this massive ecosystem that's really hard for anyone else to copy. And then you've got intangible assets, the brand name, recognized globally, and the trust companies place in them for data security. That trust is hard-earned and valuable.
Can you paint a picture? Give us a real-world type example of how hard it would be for a big company to switch.
Sure. Let's imagine a big global pharmaceutical company, a Fortune 500 name. They've been using Salesforce for, say, 15 years plus. Their sales reps, maybe tens of thousands worldwide, use custom setups in Sales Cloud to manage relationships with doctors, track drug samples, ensure they meet all the complex regulations in different countries. Their patient support teams use Service Cloud, deeply tied into medical systems, handling millions of sensitive calls and messages. Marketing Cloud runs personalized campaigns, all based on that deep history of data they've built up. And on top of that, they've probably installed hundreds of specialized apps from the AppExchange for things like clinical trial management or tracking drug distribution.
Okay, so it's woven into everything.
Everything. Now, imagine the CEO says, let's switch to competitor X. The pushback would be immediate and immense. You're looking at direct costs easily in the hundreds of millions, maybe billions, for new software, consultants, you name it. But the indirect costs are the killers. A multi-year project just to try and move all that sensitive patient and doctor data with a huge risk of errors or breaches, massive disruption to tens of thousands of employees' daily work. Sales could dip, patient support could suffer, compliance nightmares, the risk to revenue, to the reputation, to patient trust. It's potentially catastrophic. The sheer pain, cost, and risk makes switching practically unthinkable. They are locked in.
That really drives it home. So this moat, this fortress, is getting stronger or weaker?
All the signs point to it actively widening, especially with their big push on Data Cloud and Agentforce AI. As companies bring more and more of their data into Salesforce via Data Cloud to fuel those AI tools and get better analytics, the platform becomes even more central. The data gravity increases. It gets harder and harder to pull that data out. And every new app on the AppExchange, every employee trained, just adds another layer to the defenses. It feeds itself.
It's fascinating because you often hear users complain that Salesforce is too complex, the learning curve is steep. But you're saying that complexity paradoxically helps the moat.
Precisely. It's a brilliant, if maybe unintentional, side effect. Because it is powerful and customizable, companies have to invest heavily to make it work for them. They spend money on consultants, developers, and a ton on training their own people. That's a huge sunk cost. Like an IT director might tell you, yeah, it's complex, it's expensive, we complain. But we spent years and millions tailoring it, ripping it out now impossible. It's the backbone.
Right.
Once they've made that investment, tailored it perfectly, the idea of starting over with something else just seems irrational. So yeah, the complexity complaints, they actually reinforce the stickiness.
Incredible. So their competitive position seems incredibly strong. How do investors usually think about these kinds of advantages? You mentioned mental models earlier.
Yeah, Salesforce is almost the poster child for a moat built on high switching costs, just like Buffett and Munger describe. That annual renewal isn't really an active choice against competitors for many customers. It's passive acceptance because the alternative switching is just too painful, too costly, too risky. They rationally choose not to leave.
And Charlie Munger's Lollapalooza effect, you mentioned that before. Does that fit here too?
Absolutely. It's not just one thing making Salesforce dominant. It's the combination, the synergy of multiple powerful forces working together. You've got the deep operational integration, the high switching costs, layer on top the AppExchange network effects, constantly adding value. Then add the trusted brand built over decades. Now add the increasing data gravity from Data Cloud pulling everything into one place. And then layer Agentforce AI on top, using all that data to provide unique value. When a customer uses Sales Cloud, Service Cloud, Data Cloud, and Agentforce AI together, the value isn't 1 + 1 + 1 + 1 + 1 + 4. It's more like 1 by 1 by 1 by 1. But the factors amplify each other. It's multiplicative. The whole system becomes way more powerful and way stickier than just the sum of its parts. That's Lollapalooza.
Those aha moments are great. Understanding those models really clarifies why some businesses are so durable. Okay, moving beyond the strategy. What about the people? What's the word on the street, the scuttlebutt, from customers and employees?
Well, based on analyzing customer reviews, things like G2 reports, you get this picture of, let's call it deep respect and necessary tolerance. It's not like a consumer brand where people talk about loving it. It's more like, wow, this thing is powerful, indispensable, even if it's sometimes a pain.
So respect for the capability, tolerance for maybe the complexity or cost. What are the main positives and negatives people mention?
Positives usually center on how comprehensive it is. It does almost everything customer related, highly customizable, drives real efficiency gains when used properly. It's the industry standard, scalable. People respect its power. You might hear, it's a beast, but nothing else really compares for what we need. Negatives. Complexity, definitely. Steep learning curve. The costs, especially for smaller firms or if you're not using all the features, the UI can feel overwhelming, often needs significant training or consultant help. A common gripe might be, it works, but it feels like overkill sometimes, and the bills are high.
But that very willingness to put up with the cost and complexity, that itself is proof of how critical it is, right? That necessity, even without pure adoration, speaks volumes about the moat. What about the view from inside? Employee sentiment.
That's where you see maybe a bit more of a cautionary signal lately. Looking at public forums, Glassdoor, some media reports, there's been talk of the culture shifting, especially after some big layoffs in late 22, early 23, and this clear pivot towards driving up profit margins. Some employees describe it as becoming more bureaucratic, maybe less mission-focused than it used to be.
Right, I think we saw those Glassdoor ratings dipped a bit, from maybe 4.5 down to 4.2 or so, which, 4.2 is still pretty good for a giant company, but that drop, based on thousands of reviews, it's statistically noticeable.
It is noticeable, and it's a real risk to monitor long term. Salesforce's strong, innovative culture was always a key part of its success, attracting talent, driving innovation, keeping product quality high. If that culture degrades significantly over time, it could eventually impact their ability to innovate, especially with complex things like AI, execute well, and maintain that product edge that fuels the moat. It's not just about perks, it's about the engine of the business.
That's a great reminder. Culture isn't just fluff. It can be a real competitive edge or a hidden vulnerability. Okay, strong moat, some internal cultural shifts to watch. Who are the main competitors trying to breach these walls?
Well, it's a very competitive space, make no mistake. But Salesforce has held on to clear market leadership for years. Their share is something like 26%, which is more than the next few competitors combined. Quite dominant. The main challengers are, as you'd expect, other tech giants. Microsoft with Dynamics 365, and SAP with its various CRM offerings like Sales Cloud.
Two absolute behemoths. How do they compete? What are their angles against Salesforce?
They each play to their own strengths. Microsoft's game is all about bundling and the ecosystem. They've got Office 365, Teams, Azure everywhere, so they offer Dynamics 365 often as part of a package deal, deeply integrated with the tools businesses already use. They compete hard on price and convenience. The pitch is basically, it's good enough, it works with everything else you have from us, and it's probably cheaper.
Makes sense. Leverage the existing footprint. What about SAP?
SAP's strategy is more about extending from the back office. They dominate the ERP market, the systems running finance, supply chain, HR for huge companies. So they position their CRM as a natural extension of that core. The promise is seamless data flow from manufacturing and finance right through to sales and service. Get a single view from end to end with one vendor. That appeals to companies prioritizing that deep operational integration, especially in manufacturing or complex industries.
So given these powerful competitors playing to their strengths, what keeps Salesforce on top? What's their counterpunch?
It really boils down to unwavering focus and best-of-breed depth. Since 1999, their mission has been CRM, now AI CRM. That's it. 2 decades plus of focusing only on that has created the most mature, feature-rich, scalable platform dedicated purely to the customer lifecycle. While Microsoft and SAP have broader portfolios, Salesforce wins on sheer depth and specialization in CRM. And crucially, the AppExchange amplifies this. It's the biggest, most vibrant ecosystem of third-party apps by far. No one else comes close to the range of specialized solutions available there. That depth is their killer advantage.
Okay, we've really taken apart the business, the moat, the competition. Let's pivot now to the people leading the company and its financial strength.
Well, leadership has been incredibly stable. Marc Benioff, co-founder, has been chairman and CEO since day one back in 1999. That kind of continuity is really rare and allows for consistent long-term strategy. His philosophy is famously stakeholder capitalism. The idea is that focusing on value for customers, employees, partners, communities, the planet, that ultimately drives long-term shareholder value by building a resilient, trusted company.
And you believe that's more than just talk. It actually influences decisions. How about incentives? Are executives aligned with that?
It seems to be core, yeah, and executive pay has evolved, partly due to shareholder pressure, actually. The latest plans for FY25, FY26 are heavily weighted towards long-term performance-based stock awards. And these awards are tied directly to hitting targets for profitable growth and, importantly, the success of Agentforce and Data Cloud. So they only get the big payouts if those strategic initiatives deliver. Plus, Benioff himself has massive skin in the game. He owns over 29 million shares, something like 3% of the company. That aligns interests pretty strongly.
That's a serious stake. Okay, what about how they've used capital over the years? Has that strategy been consistent?
Not entirely consistent, but arguably quite rational in its evolution. If you look back, say, 2011 to 2021, it was all about growth through M&A. Big, splashy deals, ExactTarget, MuleSoft, Tableau, Slack, billions and billions spent to buy capabilities and broaden the platform beyond just core CRM. It was about building out the cloud suite.
Right, I remember those deals. Huge price tags.
Huge. But then, as the company got bigger and growth naturally started to slow down from those hypergrowth rates, the strategy shifted. Around 2021, 2022, management pivoted towards more balanced, profitable growth and started returning significant cash to shareholders. August 2022, they announced their first ever share buyback program, $10 billion. And in FY25, they returned over $9 billion through buybacks and a new dividend.
So that shift from growth at all costs to profitable growth plus returns, does that pass your rationality test for capital allocation? What does it signal?
Oh, absolutely. It's textbook rational behavior for a company maturing. They recognized they were transitioning from that hyper-growth phase to being a mature, highly profitable leader, and they adjusted the financial strategy accordingly. It's also a powerful signal to the market, and internally, too. It enforces capital discipline. The market used to value them purely on growth, expecting every dollar to be reinvested. By starting buybacks and dividends, management commits to discipline. Now, any potential M&A or big internal project has to compete against the alternative of just returning cash to shareholders. It forces selectivity, which should lead to better capital allocation and higher returns over time. It's a sign of smart stewardship adapting to reality.
That's a great point. It's not just about slowing growth. It's about adapting the financial levers appropriately. So beyond management, what about the raw financial health? Is Salesforce fundamentally a strong financial entity? A cash cow?
Well, if you just look at the GAAP net income, the official accounting profit, it can bounce around a bit. That's often due to big non-cash charges. Things like stock-based compensation for employees or amortizing the value of intangibles from all those acquisitions. These hit the income statement but don't necessarily reflect cash flow.
Right, so the accounting profit might not tell the whole story. What's the underlying cash generation like?
That's where the real strength lies. The business is an incredible, reliable generator of operating cash flow and free cash flow. Tons of it. It's a direct result of that subscription model customers often pay up front, so the cash comes in nicely. In FY25, they generated a record $13.1 billion in cash from operations. That's up 28% year over year. That's the real engine.
$13 billion in operating cash flow. Wow. Okay, let's look at some key quality ratios. Return on invested capital, ROIC. How's that look, especially after all the goodwill from acquisitions?
Yeah, historically, ROIC was suppressed by all that M&A goodwill, inflating the invested capital base.
Well, what's the trend now with the shift in strategy?
It's clearly trending up. It's moved into the high single digits now, maybe 7-9% range recently. It's heading in the right direction. The key milestone for investors is seeing if they can push that sustainably into double digits. That's often seen as the mark of a truly wonderful business, consistently earning high returns on the capital it invests.
Okay, trending up, aiming for double digits. What about free cash flow conversion? How good are they at turning those accounting profits into actual spendable cash?
Exceptionally good. It's a real highlight. In FY25, for example, they generated $12.4 billion in free cash flow from $6.2 billion in GAAP net income.
Wait, so that's a 200% conversion rate.
Exactly. For every dollar of reported profit, they generated $2 of actual free cash. A conversion rate consistently over 100%, like that is a strong sign of high-quality earnings and efficient operations. Shows the power of collecting cash up front.
And the balance sheet, how much debt are they carrying?
It's very strong. Fortress-like, really. Their net debt to EBITDA ratio is very conservative, around 1x as of early 2025. That gives them huge financial flexibility. They can handle downturns, keep investing in R&D, especially AI, maybe do smaller acquisitions, or keep returning cash to shareholders. They're not constrained by debt.
We have a table showing these trends. ROIC definitely climbing from low single digits to around 8%. Free cash flow has really ramped up from under $5 billion to over $12 billion in 5 years. FCF conversion consistently strong, often way over 100%. And net debt EBITDA staying low and manageable around 1x.
Yeah, those numbers really tell a story. It's not just abstract concepts. You see a business model that throws off enormous cash, improving returns on capital as management focuses on profitability, and a super strong balance sheet providing resilience. It paints a picture of increasing financial quality.
Okay, this brings us to the million-dollar question, maybe the multi-billion-dollar question for investors. Valuation, risks, catalysts. What's the current price tag look like? What could go wrong, and what could make the stock really perform?
Well, historically, Salesforce always traded at a hefty premium. Think PE ratios over 100, price sales over 10. That was the price for 20-30% growth and market dominance.
But that's definitely changed, right? The valuation has come down.
Oh, yeah, significantly.
Yeah.
As growth slowed to, high single, low double digits, still great, but not hypergrowth. The market reset expectations. Add in the broader tech correction and their own pivot to profitability. The multiples compressed a lot. Now you're seeing TTM PE more in the 30-40x range, PS around 6-7x. It reflects that shift from hypergrowth story to mature leader.
So cheaper, yes. But is it cheap enough to provide that margin of safety investors look for?
Well, for a high-quality compounder like Salesforce, you're probably not going to find it at a statistically cheap PE, like single digits, unless something is seriously wrong with the business. The margin of safety here isn't about buying it dirt cheap. It's more about paying a fair price that doesn't rely on heroic growth assumptions to get a decent return.
So if not a low PE, where do you find that safety margin?
It comes from a few places. One, the current valuation seems to bake in the slower core CRM growth, but maybe doesn't fully price the potential upside from AI and data cloud if they really take off. There's an embedded option there. Two, getting a chance to buy during a market panic or recession when even great stocks get thrown out. Three, buying on temporary company-specific hiccups, a slightly weak quarter due to currency swings or longer sales cycles, things that don't break the long-term story but might scare off short-term traders.
It's a different way of thinking about value. Understanding the business quality protects you, not just the price tag. Buffett's wonderful company at a fair price. You'd say Salesforce qualifies as wonderful. Is the price fair now?
Based on everything we've discussed, the moat, the management, the financials, yes, I think it strongly qualifies as a wonderful company.
But the price is always the decider for returns.
Always. And the current valuation, it's much more reasonable than it was, but it's not deep value. It feels like a fair price for a great business. Mm-hmm. Investing today means you need to believe it can keep compounding its intrinsic value nicely from the starting point to meet your return goals. Price discipline is key.
What are the big engines for future growth? And conversely, what are the nightmare scenarios, the risks that could permanently damage the company?
The number one growth engine, looking forward, has to be the successful adoption and, crucially, the monetization of Data Cloud and Agentforce AI.
That's the next big wave, their potential new S-curve.
Exactly. If they can get customers to unify data in Data Cloud, then use Agentforce AI on top of that for real business impact. That lets them sell new, high-value, high-margin services into their massive customer base. How well they execute on that, getting adoption, figuring out pricing, that's going to determine the growth story for the next decade, I think.
Okay, that's the upside. What about the downside? What are the truly existential risks?
Even with all its strengths, there are real long-term risks. First, technological disruption. Maybe a competitor, probably Microsoft, or even a new player, figures out a way to offer a good enough CRM that's radically cheaper, easier, or built on some entirely new AI-native architecture that leapfrogs Salesforce. If someone cracks the code to significantly lower switching costs, that could erode the moat.
That's always the fear in tech. What else?
Second, a catastrophic security breach. Trust is everything when you hold sensitive customer data. A massive breach would destroy brand reputation, lose customers instantly, and lead to huge fines. It could be an unrecoverable blow. And third, integration failure. They spend over $50 billion buying Slack, Tableau, MuleSoft. What if they can't truly integrate them into one seamless platform?
The FrankenCloud risk.
Exactly. A complex, clunky, expensive patchwork of tools that doesn't deliver the promised synergy. That could make them slow, bureaucratic, and vulnerable to nimbler competitors offering simpler solutions. Diversification, as Peter Lynch called it.
Right. No business is invulnerable. Understanding those risks is critical. Are there specific things investors might watch for as potential positive catalysts?
Two main ones come to mind. First, accelerated AI monetization. Management guided for real financial impact by FY27. If we start seeing clear proof in quarterly results, big jumps in revenue, specifically from Data Cloud or Agentforce, sooner or stronger than expected, that could lead to a significant positive re-rating of the stock. Second, an expanded capital return program. If the board significantly boosts the buyback or speeds up dividend growth, that signals huge confidence in future cash flows. It reinforces the disciplined allocator story and could attract more value-focused investors.
Okay, putting it all together, how does the market generally see Salesforce right now? And what's the potentially more insightful contrarian view based on our deep dive?
The prevailing market view, the sort of consensus narrative is, Salesforce is a maturing giant. Hypergrowth is over, settling into slower growth. There's skepticism about integrating those big acquisitions, and caution about how quickly AI will actually boost the bottom line, seen more as a risk than an immediate win. Kind of a show me the money attitude.
But our analysis suggests maybe there's more to it than just slowing growth.
I think so. That consensus view feels like first-level thinking. It focuses on the core CRM deceleration and tends to look at things like Slack or Tableau in isolation, questioning if they overpaid. It potentially underappreciates the compounding power of the integrated platform. The contrarian view, the second-level insight perhaps, is that the real magic isn't in the individual parts, but in the synergistic flywheel of Data Cloud, the foundation, the core apps, engagement, and Agentforce AI intelligence working together.
So the market sees a slowing giant. But the deeper view sees potential for a powerful second act fueled by this integration.
Exactly. The integration isn't just additive, it's multiplicative. By creating this single trusted platform for unified data and powerful AI, Salesforce could fundamentally increase customer stickiness and the value they provide, potentially re-accelerating growth and widening the moat even further. The market sees an incumbent maybe past its peak. This analysis sees potential for a very profitable second act if they execute on the data and AI vision.
That's the core of second-level thinking, isn't it?
Yep.
Looking past the surface narrative to the underlying dynamics. Okay, let's wrap this up. We've seen Salesforce's dominant position, its wide moat built on switching costs and network effects, its rational management pivoting to profitable growth and returns, and its strong financials. The big question, wonderful business at a fair price, potentially poised for that second act driven by AI and data.
So the bull case in a nutshell. Dominant franchise, widening moat, huge AI growth potential, disciplined management, cash machine financials. Bear case. Core business slowing, big integration risks from M&A, tough competition, potential culture issues. And for the red team challenge, the really worrying thought, the counter-argument, could Salesforce become the next IBM or Oracle, a dominant incumbent that gets bogged down by its own size and complexity?
That's a provocative comparison. Paint that FrankenCloud nightmare scenario a bit more.
Well, imagine those big acquisitions. Slack, Tableau, MuleSoft never truly mesh. customers end up with this complex, expensive jumble of tools that don't talk to each other smoothly. It requires tons of consultants just to keep it running. The company becomes bureaucratic, slow to innovate because it's managing all this legacy stuff and complexity. Its size becomes a liability, not an asset. Then a nimbler, AI-native competitor builds something cleaner, simpler, maybe cheaper from scratch. Salesforce, stuck with its complexity, can't respond fast enough. They start having to compete on price, margins erode, market share slips. Investors who paid a fair price for a wonderful company find they actually bought a value trap at the peak. It's the risk of mistaking maturity for permanent dominance.
A sobering thought. So as you, the listener, think about Salesforce, consider this. Is its huge size and installed base a massive advantage now, letting it dominate the AI transition? Or is that very size and complexity becoming a dead weight, making it too slow to adapt to the next disruption? Your answer there might really shape how you view its future. Thank you for joining us on this deep dive. We hope these insights help you explore and understand the business world a little better.